Hello, friends. Today I want to introduce you to MI25, which is our flagship small cap strategy. The whole idea of MI25 is to try and extract the alpha from small cap stocks. Small cap stocks have a phenomenal alpha quotient. If you see the historical trends, small caps, obviously, because these are small companies which have the potential to grow larger and at a faster rate, there is more potential to extract that momentum from them. If you see the nifty small cap chart on your screen, you can see we've had several extremely strong rallies. So in 2004-5 to 2008, you had the small cap index go from nearly 1000 to 6000, so 6x. And then there was a crash, and post that again from 1500 to nearly 9500 in the next 7-8 years. And then of course another crash, and followed by the COVID crash, and then again from around 3000 to 11000. So there are pockets of outbursts in the small cap sector every few years, and then there are drawdowns that happen. So you can see big moves up and some drawdowns here. Now drawdowns in small caps can be very very sharp, so because of the volatile nature of the instrument itself. I mean, these are small companies, and there is much more speculation, much more leverage that is happening outside the market on these stocks. And sometimes the emotional rise and fall in small caps is much more accentuated versus large and mid caps. You can see a 75% fall here, a 66% fall here, a 34% fall here. So the falls are dramatic and huge when they happen. They happen once in a while, but they do happen. Now, the problem is that, yes, with small caps, you make a lot of money in the up cycle, but then in the down cycle you lose most of it. That has been the problem of investing with small caps. So you need to find a way where you are outperforming when the markets are going up, small caps are going up, but then when the small caps are coming down, you need to curtail your losses somewhere. So the idea is the concept of getting into deep drawdowns and the problem with it. So analogous example, you fall into a 5 feet ditch. You're walking on the road, you fall 5 feet lower. You'll you'll climb back up and start walking again probably. But if you fall into a 15 feet ditch, you may not be able to recover so easily. So drawdowns are hazardous. So we need to somehow reduce drawdowns. That should be one of the key aims of any strategy. And you can see, as the drawdowns become deeper and deeper, you need higher and higher returns to break even. So a 60% drawdown will require you to go up 150% to just reach that same place where you were. So if you can keep your drawdowns low, you can very easily come back to your original place and proceed further from there. So how does MI25 solve this? So let's take a case study. So this is Nifty small cap index. We had a nice rally in 2016-17, and then a much larger sort of bear market in 2018, culminating with the COVID bottom in 20, and then a huge post-COVID rally after that. So this is the three scenarios that we are seeing. So let's take the first case, the first bull rally here, 16-17. So what did MI25 do? It performed at 218% versus 80% on the small cap index. So this is the first phase of that. Now in the next phase, the market cracked brutally over almost more than 2 years, 2 years and 1/4 of time. What did MI25 do? It cracked with the index, but after some point you're seeing that it shallowed out here while the index kept going down. So index dropped 55%, you dropped only 28.8% because the strategy started to move into cash. As the fall became more and more deeper, the strategy will push you towards cash, and probably somewhere around here we were 80-90% cash here. Then there is a huge rally that ensued from the COVID bottom till for the next 1.5 years. Now you're sitting in cash, so it will take time for, some lag will be there when the cash will get deployed. And you can see this in this chart, that from that March low to April 22, there was a lag initially, and then it caught up, and then the market became choppy, and it became stagnant after that. So uh, what did we witness? That while the market, this is the overall period now, 16 to 23, while the market was dropping dramatically here, the drop in the strategy was not as dramatic, so you were able to reduce your drawdown to some extent. And then when the market outperformed, you outperformed in a very big way. So both outperformance of the market here, you can see outperformance in a big way, shallower drawdown, outperformance in a big way, and of course in choppy market it will chop around also. So coming back to the strategy, two phased objectives of MI25. When market is going up, outperform on the upside. When market is coming down, try to outperform on the downside also by reducing your drawdown, and not allowing the strategy to bleed as much as the index. Let's look at some of the metrics. So absolute returns from 1st April 16, 1st April 16, because that is when we actually started weekend investing and this strategy. It was available on Smallcase, I think, from last few years, but it has been in play since 2016, and many users have used it since 2016. So absolute returns 505% versus small cap index returns of 132%. So huge beat. I mean, there's no comparison actually. CAGR 30.2% versus 13.2%. Max drawdown. See, this is the most important thing. My max drawdown minus 29% versus 60% on the index. So 100 going 60% down is 40. From 40, you need to have 150% return to come back to 100. So that is the key here. ROMAD ratio of returns to max drawdown 1.04, very very healthy, versus 0.22 on the index here. 100 rupees invested in MI25 in April 16 would today be 606 rupees, 234 on the index. So you can see the huge difference between the two. Of course, we are not taking taxation, dividends, etc. into this account. 3-year absolute rolling returns. So what is 3-year absolute rolling return? So any 3-year period, what is the total return? So initially in 2019, from 16 to 19, it was 140 plus percent. Then maybe 3 years leading to January 21, it was nearly about 20%. Then again 180% by end of 21, and currently at 146% in January 23. So what this is telling you, that if you invested in this strategy in any 3-year period, what would have been the best and worst situations? So the worst situation would have been total of 20% return, and the best situation would have been total of 180% return. So it will hugely vary, but it will essentially showing you, this chart is showing you how much of a over performance this strategy has done. Now we also look at 4-year absolute return. So 4-year absolute return is 130 going to 200 plus, coming down to 100%, 152. So over any 4-year period, in the last 7-year periods, 7 years since we are calculating this roughly, no 4-year period is given you less than 85-90% return. So any 4-year period, you would have got a minimum of 90%. That is huge. I mean, if you think about it, given that the volatility that we've had on the index, that would have ranged between minus 20 and plus 87%. At the lowest point here at around 90%, you would have seen about 30 odd percent on the index. Now on CAGR basis, 16 to 22, you have going from 35% down to about 22%, up to about 42, 43%, and at 30% now. So this has been the CAGR progression. For the index, it would have gone into the negative territory in COVID time, but later on stable at 13.31. So the average CAGR that you would have, at any point you would have entered would have been much, much higher than the index. That is very, very clear here. The 3-year rolling CAGR also we have calculated. So any 3-year period that you would have stayed invested in this strategy, the CAGR would not have dipped below, let's say, single digit 6-7%, whereas on the index it would have reached minus 16% also. And for 3 years ending March 2020, the CAGR on the index was minus 16-17%, and it was roughly about plus 10% on the index. So while these numbers may not be too significant also, but what it does is that it keeps your confidence very high. If over a last 3-year period when the market is crashing, minus 15% each year, and you've done plus 10%, that gives you a huge confidence booster as to what strategy you are following, and that strategy being able to deliver what it's supposed to do. Now let's also look at some SIPs. If you were doing, let's say, SIP of 10,000 rupees per month, over this entire period you would have contributed 8.2 lakh rupees. If you had invested that money in the small cap index, that money would have grown to 13.27 lakhs. Still quite, I would say, reasonable return. XIRR of 13.96%. Some periods where it would have gone below capital. So from about October 18 till about October 20, for 2 years you would have been below capital, even after being 5 years, 4.5 years into the strategy. So that may have become a bit unnerving if you had done that. If you had invested in MI25, your corpus would grow to 19.27 lakhs in the same period. But the best part is that it never went below your capital. So at no point did you feel that your capital was not making money, although it did go flat from January 18 onwards when the small caps crashed, but gradually recovered and then overperformed over a period of time. So with a XIRR of 24.82, which is huge. I mean, if you can achieve anything above 15% in any strategy, I feel that you can really accumulate very well over the very long period. These are the quarterly results comparison of MI25 versus small cap. I'll just quickly go through these numbers so that you can see that in most quarters you will see that MI25 will outperform either on the upside or on the downside. Like for instance, this example here, market went down 6%, but strategy was up 5.9%. Like in this example, market went down 13%, but the strategy was down only 11.9%. So small beats will make up for a large gain. Minus market went down 34%, strategy was down only 11%. Here the strategy lost a bit more than the market also. Here again it beat a bit. So you can see on the higher side also, market went up 21.6%, the strategy returned 40.5%, and so on and so forth. So let's also now look at some real stock stories from here. Some very good performers and some very bad losers also. So we will get both. I mean, one cannot expect that all stocks will only keep doing well. So Goa Carbon, one of the star performers, entered at 140 rupees somewhere here in 2017, went all the way to 1200, exited near 884, profit of 500%, and then later on the stock just collapsed. So avoided this fall of almost 80-90% here. Another one, Loras Labs, this is very much in the news these days also. Entered around 100 rupees April 2020, exited at 536, profit of 442%, and currently as I'm recording this, it is somewhere near 320 odd rupees. So avoided all this entire fall and pain. More than the fall, the pain of the fall and the non-optimal use of capital that happens from the top to the bottom should be avoided. Alkylamine, another stock, entered at 687, went all the way to 4700, we exited near 3700, currently languishing at 2600 and so on and so forth. Now, some other stories where at least the exit you may have exited in a loss, but it still saved you money. So Madhukan projects we bought at 62, but we exited at 639, took a loss of 38%, and after that the stock just went to virtually nil. Den Networks, again, we entered here when the momentum was really strong, but then there was a sudden collapse and we exited the stock. Later on, again, it went up, but it just collapsed after that. So, about 40 to 50% trades will really go right, rest will go wrong. But the ones that go right, the average gains you will make on that uh, on the winners will be much higher than your losers, and that is the key that really keeps that magic going. So just to summarize, MI25 is a weekly rebalanced absolute momentum strategy. It will pick up to 25 trending small cap stocks from the high alpha small cap category. It is rebalanced on a weekly basis. The recommended capital is 5 lakhs to 30 lakhs, and the fee is there in front of you on the screen. Now, you may ask why weekend investing? Because we have specialized in momentum investing from the very start. We have been doing only momentum investing since 2016 because we feel that this is the best factor investing that is available. There are 200 years of data that is available, a lot of research that is available, which clearly shows that momentum investing has beaten all other formats of investing. We have a very large satisfied user base of 13,000 plus people. This kind of user base doesn't come around without people appreciating what the magic of momentum investing is. What I've seen over the period is that as some person may come into momentum investing, try it out for a year or two, realizes that yes, this is a no nonsense, very peaceful way of investing, brings more investment into it from other market vehicles. We have built a huge repository knowledge base on Weekend Investing Hub. So there is no dearth of FAQs, user manuals. Um, you know, we have a huge repository on the question bank that we have created. A lot of folks appreciate our support service. We are the first small case manager to launch a loyalty discount program called Wild. So as you move into your annual subscription from year to year to year, your subscription rates keep coming down uh, as you become a senior in that subscription. Testimonials from Weekend Investing family, we have dedicated a page on our website which is dedicated for the testimonials from the weekend investors, and you can go through that and see what kind of testimonials we have received. And of course, all kinds of support videos are there on YouTube. We run a Telegram channel where we are able to update timely if there's any immediate information to be broadcast to our users. uh, we are available on Twitter. We are basically on the support front. We don't want to let anybody have any questions remaining and not being able to reach out to us immediately. So that is our sort of USP. And of course, the momentum investing performance is itself the reason why you should consider weekend investing. So this is all I have for this particular presentation. Thank you so much. Please go ahead and subscribe to MI25 if you like. And thank you so much for your time. Bye.